Welcome to 15-Minute Fundamentals, where we break down crypto projects and learn about the drivers behind the data you see on our charts. Today, I'm joined by Quag from NFTX, a liquidity protocol for NFTs. Hey Quag, welcome to 15-Minute Fundamentals. It's great to have you on.
Great to be here.
To kick things off, could you give a quick intro to NFTX?
Yeah, so NFTX is a liquidity protocol for NFTs, and I guess most notably it's like fully permissionless, so everything happens on chain. It's not like an OpenSea marketplace where it's all handled on databases with signatures. It's a fully on-chain liquidity protocol for NFTs.
How does that work in practice? So at a bit more of a technical level, what is a liquidity protocol for NFTs?
So I guess the main underlying tech behind it is you have an NFT, so an ERC 721 or 1155, which traditionally isn't fungible, and you would deposit that into one of the NFTX vaults, and in return for that, the vault would take your NFT and then hold it in the vault, and it would return you one ERC20 token that sort of represents that NFT in the vault. So like one of the key concepts of NFTX is to like vaults to NFTs, there's always like a one-to-one mapping of like the ERC20 token. So we'll say Punk, for example. If you put a Punk into the vault mints one Punk token, and then you get back one Punk token. Now, if you're selling there and buying, there are fees attached to that, and the fees are paid in the Punk token. But that's ultimately how it works. You deposit a NFT into the vault mints a token and gives that out. And to then take an NFT back out of the vault, the contract requires one Punk token to go in, at which point it will then burn that token and send a Punk back out.
Yeah, so it's a very different model to what users might be used to seeing with peer-to-peer marketplaces like OpenSea and LooksRare. And on that, it would actually be really interesting to hear what the main innovations are from a user perspective that you introduced with your model compared to these other solutions.
I'm pretty sure it was the first, and if not it was the first, it was definitely, I think, the most successful at basically making on-chain NFT liquidity effectively. So when this came out, very late 2020, early 2021, like the NFT scene itself was really only just starting to take off. Yeah, things like the early hash mask mints and stuff, and there wasn't really much activity. There's probably like 20 collections total that people like knew at that time, maybe even 10. So this was sort of the first real attempt, I believe, at sort of turning what a non-fungible token to something fungible. And at the start, it was just quite a crude interface where people could LP and sort of just earn regular like Sushi AMM or Uni AMM fees on these pools. It was quite clunky and slow, but it was quite a big step forward. I think in the tech at that time sort of unlocks a lot of potential for people who wanted to be able to sort of buy and sell or start running arbitrage on stuff if they could realize they could buy on OpenSea and then mint it into NFTX and then sell that token into Sushi. I think people were quite profitable in those early days, allowing sort of price floors to be stable and the opportunity for arbitrageurs to come in. Then in time, I guess as it grew, the product team sort of came on, which is where I spend most of my time, and that was turning it from just effectively what really at the time was like a sort of proof of concept protocol. When we saw that there was like actual genuine interest and uptake in the ability to get these NFTs into like pools of liquidity for people to buy and sell into, it became a lot more about building up platforms for people to actually see what was in there. Like otherwise you were querying to get token IDs, you were referencing token IDs on an OpenSea, and it was really quite difficult. So the big progress from that point was sort of building up this the marketplace view where you could see what was in the vaults, you could buy and sell directly. We sort of built out these Zap contracts that allowed you to go in and sort of, instead of having to sort of previously you had to mint the token directly on the contract, you get the token back, you go to an AMM, it's a slow process. We made these sort of Zap contracts that allowed you to do that directly on the web app itself, which again has sort of enabled users much quicker access. People who aren't really technically savvy, a lot of people sort of came in with the NFT wave and they can like control a wallet, they know about using an interface in a web app, but having to like dive into Etherscan and do things directly, it was a bit confusing, or really dealing with AMM pools. So that allowed those sorts of users to come in and be able to sort of sell instant liquidity, which is, I think, the whole NFTX model and the idea of instant liquidity of NFT floors kind of kickstarted the whole like MetaFi scene, really, with like the financialization of NFTs when people realized that there was sort of this liquid floor available. I think it really sort of helped boost the idea of quote unquote floor that everyone talks about now, what is basically the best bid, on the table. And that came from like these, at the time, like these sushi pools that were just representing the liquidity. So it wasn't like a person, having to buy. This was literally just a permissionless, always there liquidity pool. And if there's always a buyer of last resort, and it was always the liquidity pool.
Exactly, and instant liquidity at a floor price of an NFT is a pretty valuable feature. I could have used that a few times over the past year. Can you actually explain how these floor prices are determined on NFTX?
Prices is fully determined by effectively the market or the liquidity pools. So anytime it's basically, it is since the NFTs are minted into ERC20 tokens, the whole NFTX pool is basically just backed by a liquidity pool of ETH and however many of the tokens, and so like Punk and ETH are in the Punk vault basically. And every time you go and buy a Punk, obviously it puts ETH into the pool and takes Punk out, and that puts price up the sort of way that the usual people who are familiar with like buying and selling in any sort of like Uniswap or sushi pools, there's the idea of slippage and having deeper liquidity. The deeper liquidity, the more you can buy without prices going up lots. So we get a lot of questions sort of come in the discourse being like, oh, why are the prices so high in NFTX, or why is the price so low, or what's the difference? It's because, oh well, as things get more expensive, you need more and more and more liquidity in the pool to sort of keep those spreads down. And that's where we're starting to see other tooling and other protocols come into the vein now to sort of try and handle that issue. But yeah, at its core, NFTX pricing is handled basically purely permission. It's just we have a lot of bot arbitrage now. So someone will go onto OpenSea or LuxRare or Sudonow, and they'll list at whatever price. A bot will just be scanning an MEV bot, and it'll be like, I can buy that for 0.1 on OpenSea. I can sell it immediately into NFTX for 0.1, whatever, tiny percentage profit points, but just running over and over and over again. So yeah, prices are basically kept in line just by arbitrage, the same way they're effectively kept in line anywhere. When the prices go up, people will buy it because NFTX is cheaper, or when the prices go down, they'll sell into it. And it's just sort of kept in line mainly by arbitrage in the market.
Got it. Yeah, you guys definitely paved the path for creating liquid markets in the NFT space. And, when you create a solution to a clear problem, you'll probably find some competition up against you at some point. And kind of related to that, I'd be keen on hearing what the main differences are between NFTX and Sudoswap, which also facilitates liquid trading across floor prices of NFTs.
I mean, the main obvious difference is we deal with fractionalized NFTs basically. So we're fractionalized and we're dealing with like partial amounts of token that represent the NFT, and Sudo is whole units. You're buying and selling actual NFTs. So I would think like Sudo is actually much more akin to like an on-chain OpenSea basically. It's like a full market. You don't have to. You can list anything at any price on Sudo, and it will be sold, permissionlessly. It's also on chain. So yeah, the biggest difference is we deal with fractions of tokens and a single pool. So an NFTX vault is backed by a single pool, which is why it will always trend to floor price, because it's always basically acting as like the lowest common denominator of asset. It's the liquidity pool of the amount of assets that anyone will sell into at what price or buy at that price. So if, for example, if you put in like a hoodie Punk or into the Punk pool, someone is going to, within the next block probably, because I think the Punk pool has quite advanced MEV on it, would be taken out immediately, because obviously hoodie Punks are worth far more than floor Punks, and the NFT price will track the floor price of the vault because it's an instant liquidity cost. So it's only ever going to track basically the lowest price. Whereas Sudo, it's like a collection of pools. So like when you're browsing on Sudo, it's basically you're just browsing other people's listings. And when a sell or a buy happens on Sudo, the person who owns the fees will be the person who was selling, the asset. Whereas NFTX is socialized pools. So if you are providing liquidity or inventory in NFTX, anytime there's a buy or sell or a swap on it, everyone gets the rewards shared proportionally to their stake. Whereas Sudo, obviously, it could be you could go to buy a Punk or something on Sudo, and there's 50 Punks listed, and someone buys one, and you may have had your Punk listed, either side of it or something, but you don't get any fees because yours didn't sell, basically. So that's why I sort of compare it much more to an on-chain order book, a marketplace, and it's got some cool stuff with their pricing curves and LPing ranges and stuff. But yeah, the biggest difference is it's whole units for them, whereas it's fractionalized for us.
Got it. Now, I recently read about an upcoming integration you guys are working on with 0x. It sounded pretty exciting. So could you walk me through kind of the features that'll be introduced with that?
Yeah, so at the moment, all the liquidity in FTX goes into the sushi pools. So anytime you're on the site and you deposit and add liquidity or whatnot, it'll go into the sushi pool, because that's where the NFTX rewards come from. Like the rewards that are paid for stakers come out of your proportional balance staking in the sushi pool if you're providing liquidity. But what we want to allow people to do is sort of add, we're called vault tokens, V tokens, like the Punk token. So if I say vault token or V token, I'm just referring to Punk, the ERC20 token that represents the NFT. We want people to be able to sort of provide liquidity anywhere and the marketplace to source it. So the very common thing at the moment is concentrated liquidity ranges that UniV3 offer, where you can say, I'm happy to LP Punk between like 40 ETH and 100 ETH. Like if Punk gets down to 40 ETH, I'm happy to be all in Punk. If Punk gets to 100 ETH, I want to be all out of Punk and all into ETH. And those sorts of concentrated ranges obviously allow for much tighter spreads because it's liquidity like condensed into a range, and therefore the more concentrated liquidity you have around the current spot price, the tighter your spreads will be. So the idea is that, say, someone like FloorDAO, who's like a power user effectively of NFTX at scale, part of their strategy would be, we'll LP on NFTX in the sushi pool to get our NFTX rewards, and we would also put like a chunk of liquidity in a UniV3 range sort of around spot price, because what that will do is encourage usage of the NFTX vault, because if NFTX buys and sells remain as close to spot price as possible, then there'll be much more activity, which in turn like churns the NFTX vault fees. And they would also be earning, because it's a Uniswap V3, they could set like 1% as the AMM fee, which is much bigger than the current, like you get a fee on sushi. So the idea is it allows people to do other strategies. So like put up a concentrated range. Like we just did it on the dev test. We run like a mainnet test with this the other day, and on our little dev account, we just set up a small range on like the little Pudgy's pool, where we'll just set a range between like 0.1 ETH and 0.3 ETH, and the spot price is 0.2 ETH. And then we went onto the UI and we noticed that when you're buying and selling, you see it's pulling liquidity from multiple sources now. We showed that on the UI, like, it's pulled a bit from Uniswap because of that range there. You get the best price if we're aggregating sources. So it's basically just about giving people the opportunity to add liquidity anywhere and know that it's going to be used for vault activity and activity on NFTX. Things like, balancer pools, basically. And it might be that you get in some pool rewards. So if some liquidity provider somewhere is like doing promoting or liquidity mining, rewards, like Sushi used to have Onsen rewards back in the day, and NFTX pools used to get like Onsen rewards. So it sort of allows that sort of thing. If people want to promote the usage, of NFTX pools on other platforms, they can do that knowing that the NFTX UI marketplace is going to be pulling in that liquidity. So when people buy, sell, and swap from it, they will be using that liquidity.
Got it. And onto financials. Can you walk us through NFTX's fee model? So who pays fees for what and who earns them?
Yeah, so buyers and sellers and swappers are the ones who pay the fees, and all those fees go to liquidity stakers and inventory stakers. Like the NFTX protocol doesn't take any fees. All the fees, all the rewards earned go to the people who are providing liquidity and inventory. Probably a good time to define the two different types of stakers in NFTX, right? So there's liquidity stakers. Those are the people who are pairing the Punk with ETH in the liquidity pool. And that's the most important role, basically. That's what allows the NFTX protocol to work, was the liquidity providers who are providing the liquidity for people to buy and sell into. Then the other side of it is inventory stakers. And this was actually, I think, one of the coolest probable like breakthroughs or things that has happened in the space when we launched inventory staking late last year. And that allows you effectively, just if you have floor NFTs and you're not personally attached to them, you sort of just want exposure to the project still, you can deposit them into NFTX and you will earn rewards on your vault token. And NFTX rewards are obviously paid in the vault token itself. Fees are paid in Punk, for example. So you could just have a floor Punk, you'd stake it in NFTX, and you would be earning interest, basically, in Punk on your Punk. So rather than having to sell, or I'm bullish on Punks long term, I don't want to sell. Everyone always like, non-productive assets. Everyone wants their asset to be doing something, got to be earning yield somewhere or something. These floor assets, you can just park them in the NFTX vault, and what that does is it adds inventory to the vault. That's why you're called inventory providers, because you have put a Punk in. So now anyone else can go in and buy that Punk. You are returned a Punk token as earning interest. So, in 3, 4, 5 years, when you decide you might want to sell a Punk or cash out or whatever, you could have earned, I think the Punk inventory is quite low. It's like 2% or something like that. But, you would have earned that interest just in your Punk sitting there doing nothing. And it's the most popular form of staking by far. Like inventory staking far outweighs liquidity staking because it's aside from smart contract risk, it's risk free. You're just parking it in there. You will always be able to claim the amount of NFTs back that you put in, and you're just earning interest on top of it. So those people, inventory stakers, earn 20% of the rewards. So if it's a 0.1 punk fee to sell instantly, 0.02 whatever goes to is spread amongst the inventory stakers, and that 80%, that 0.08, is spread out pro rata against liquidity stakers. And they tend to do really well, liquidity stakers, because there's so much more inventory. You have 80% of the rewards being split out across like maybe only 50% of the entire stakers. So we do see really good yields on liquidity stakers. And I think one of the best examples of that is the guy who LP'd about 17 Pudgy Penguins in like April or something, or about 2.5 ETH per penguin. It was like 47 ETH or something, and the corresponding amount of Pudgy Penguins are like 2.7 ETH or something. And they just range traded this entire time. They went down to like 1, then back up to 3, then down to 1, back up to 3 again. And this person who's LPing in this pool, they have earned over like 11 Pudgy in rewards. So that's 11 penguins. And like, I always think about NFTs really, other than like being like a social concept that we can, communities and that sort of thing, shitcoins with pictures, as Kobe would say. They're like a leverage play on ETH, effectively. Like everyone buys NFTs, and when they're selling them, they want to have got more ETH, right? The whole idea is that you are outperforming ETH. So in any sort of protocol platform where you're earning fees and you're just earning in ETH, I mean, that's great because you're earning ETH, that's great, but you're not getting the outperformance that like the NFTs, that we're attracted to, that people want, that sort of that high beta gain. So to have earned like 11 Pudgies in rewards, and obviously Pudgy is now sort of still going up, it's just been a sort of incredible, it's like a really cool use case to see somebody just set up that pool, let it run, and they're still not claiming their rewards yet. They're still just sitting there, and they've earned like 11 Pudgies and at like 3.5 ETH or something a Pudgy Penguin. They've sort of done real well. And at that point, so although now, as let's say the Penguins go to like 10 ETH or something, well then he'll be staring his impermanent loss in the face at that point. But before that happened, obviously, whilst it was correctly in this range, he's printed a huge amount of yield in the form of the NFT, so he keeps that upside exposure.
Okay, wow, that sounds. I'm actually an inventory staker in I think the other deed collection myself on FTX. It sounds like I should become a liquidity staker as well. So
yes,
need to make a few transactions there.
So a good thing to look at is if you go on like the yields.nftx.io, that's like the yield focus site. We had everything on the NFTX.io site to start with, but it became really difficult to sort of do all the yieldy things we wanted to do on top of marketplace. So we're still sort of balancing out how that's going to work. But yield.nftx.io is the main place where we show more interesting yield-based stats. And I do something, and you can look at the stakers split, which is quite an interesting thing. So if you remember, I said that 80% of the rewards go to liquidity stakers and 20% goes to inventory. That means basically like the optimal reward setup, pools really should sort of trend to the 80-20 split of stakers. But a lot of the time you'll see pools where like the stakers split is like 50%, 50%, 50%. And that again means that the liquidity stakers, 50% of these people are getting 80% of the rewards. So yeah, that's why the APRs tend to do better.
Some alpha right there. A while back you launched on Arbitrum. We don't yet have that data on our dashboard, token terminal, but how is that looking for you? What kind of traction are you seeing there?
Not a lot. There was smaller peep in the beginning, and we were using it as a sort of like testnet thing to get up and running. The main problem we hit with Arbitrum was like a lot of the infrastructure we use, like we're powered by a lot of subgraphs and stuff from the graph, a lot of decentralized tech, and it all sort of died. The subgraphs, they stopped working like the graph protocol because Arbitrum had their upcoming, which is now released, Nitro upgrade. So there was like a bunch of broken subgraphs and issues with the subgraphs on the graph, and their stance was basically, well, we'll wait for the Nitro upgrade to fix it. Now, so the Nitro upgrade has come now, and the Arbitrum vaults work again now. They've always worked, but the marketplace now, the Arbitrum marketplace in FTX works again now because the Nitro upgrade has happened. So all holdings are up to date, all your wallet balances are up to date. So I'm hoping maybe we'll see some more uptick in Arbitrum now, like maybe a secondary NFT market, or it seems to be like Solana seems to be the place maybe where that seems to be like the other sort of busy or cheaper NFT market. I'm not really sure we've seen much other than like the treasure magic stuff on Arbitrum. But I mean, yeah, it's all the issue I had before was the tech wasn't working on Arbitrum. The tech is working on Arbitrum now. So, I'm hoping maybe we'll see some more uptake in the future.
And outside of like general NFT volume and activity dying down, what would you say are like the current drivers or challenges related to your growth?
The main challenge at the moment, I guess, is like retaining interest and stuff through like a bear with NFT volumes, drying out, trying to attract talent, like bringing on more sort of Solidity devs to handle our visions for like V3 and stuff in the future during a trying time like this, where lots of sort of the interest and money or whatever has dried up, or people have left for other projects. So I think just general market sentiment is probably the biggest growth blocker at the moment. But I think a lot of the drivers we've got coming up, we are seeing more and more like protocols spinning up who want to integrate NFTX liquidity into things they do, borrowing protocols, lending protocols, having a immediately liquidatable fungible asset is appealing to a lot of sort of lending and borrowing protocols. And I think we see, and again, that inventory staking seems to, like, the more people seem to find out about it, the more appealing it gets. So we have a sort of an up only chart really on the amount of inventory stakers, as people sort of realize at the moment, I can just park this in NFTX and earn interest. So those are probably the biggest drivers at the moment. And challenges at the moment is trying to attract talent and attract liquidity into the pools.
Yeah, I'm sure attracting talent is definitely a problem a lot of projects are facing right now, and the bear market is not helping out there. And kind of related to the subject, especially technical talent, do you experience a lot of organic community contributions to the code base? Is that something you encourage at all, or are you trying to keep development somewhat in-house?
But on protocol side, like definitely, and sort of on ancillary projects, sort of friend of the NFTX chap called Quantumly is built out and sort of open source subgraph that we've used for things like token holding subgraph that we've used extensively. And that was just sort of like a community contribution. But since like the UIs are closed source, because that's basically what the NFTX DAO pays the product team to build for them, there isn't a lot of community. There's sort of a product team who works on building it. We get a lot of community feedback, so it's full of I like this, I don't like this, can we have this, a lot of requests. But in terms of like pull requests and contributions, no, it's effectively handled in-house.
And then I just had a quick question about the NFTX token. Could you describe its role?
Purely governance, in that it votes. So like NFTX is like a proper Aragon DAO, in that everything is basically handled via the governance token. Like changes to the contracts, have to get voted through with the token. So if in the future token holders wanted to see a certain amount of revenue returned to token holders, or that sort of stuff, that's what would go through governance effectively, and the token voting. And I guess loosely now, as you saw with other governance tokens, they sort of float at a sort of treasury valuation. People sort of equate the token to a claim on the treasury at worst case. If NFTX had to decide to close up shop or whatever, its treasury would get liquidated and would be spread out amongst token holders. But yeah, at the moment it's purely a governance token. I think that originally there was some put aside for liquidity mining incentives, but it never really, mercenary liquidity has never really paid off for anyone, I don't think, in the long run.
Got it. Now, a hot topic around NFT liquidity protocols has been related to creator royalties, as they're not paid in trades executed on NFTX and other liquidity protocols. I'd be keen on hearing your thoughts on this topic in general, and whether you have any plans to enforce royalties at some point, or enable voluntary royalty payments on vault contracts, or anything like that.
So I have some personal opinions, I guess, strong opinions, like loosely held, that I sort of flip-flop on all the time. I guess to start with, from an NFTX point of view, there's nothing in place at the time. NFTX always wants to do everything on-chain. I think that's so rather than the social contract of royalties, the only way it can ever sort of be enforced at the NFTX level would be if it's on chain. Otherwise, people just wrap it. There's always, you end up and they're just being avoided anyway. So we've looked into stuff, and we're sort of monitoring EIP 2981, I think, which is basically an NFT royalty standard, baked into the token. And having stuff like that available, or on-chain standards, make it much easier than at the moment you just read from a Web3 database the royalty percentage and attempt to tack that on to the transaction basically. So at the moment NFTX does nothing, because it would require something on chain more than a social contract. I mean, again, that's where token holders may come in and vote that should NFTX tack royalties onto whatever, and you get a vote on chain where the token holders could vote in it. we'd like to do stuff where it's basically up to the vault creator. I think that's sort of where our vision for V3 would go, where people like spin up these vaults. They have options on defining sort of royalties, and once those royalties are defined at like a vault level, at a contract level, they become much easier to be, I guess, enforced, so to speak, in that, it doesn't, there's no social contract or, contract relied on it. It's just, that's what the code says. That's, to interact with the contract, it requires X royalty, and therefore it happens that way. So in the next sort of version of NFTX, when we hope to have a lot of focus on creator flexibility, sort of maybe launchpad stuff where collections may launch via NFTX and hold a certain percentage of their own supply back or something, and be able to define sort of vault royalties. I mean, there will always be a marketplace that spins up somewhere that is royalty free, because free markets, basically, that's always going to happen. So our idea would be, if there's something on chain we can implement, great, we can implement it, or allowing vault creators to create. So what happens at that point is you may get like an official, let's just say Other Deeds, for example, or something, like Yuga. They're like, all right, well, we will create one on the net. It'll be like the Yuga official Other Deeds lab, and we've tacked on like a 2% royalty onto it, and that's enforced on chain. And people may use that vault, and then what else might happen is, the existing Yuga or someone else may spin up a, Other Deed vault brackets, no royalties, no fees or something, and then ultimately the market tends to decide what's used, and whether these projects then start enforcing, if you've not paid a royalty, you've come from this protocol, we'll try and blacklist. There's sort of, that feels like that's that oncoming war coming, where what might these projects do in an attempt to try and thwart off or protect their royalties. But from an NFTX perspective, it wants to just be as permissionless as possible, and therefore if someone wants to create a vault with royalties, we'd love to be able to allow them to do that with us. And at the same time, if somebody wants to create one without, that's their prerogative, and ultimately the market would decide. My own personal view is I find royalties to be very high on a liquid floor. So it's quite a tax on people who are buying and selling, I think, when the royalties happen when you have so many of an asset trading at a single price point. It at that point, it is really just trading like a sort of derivative, or just, I want to buy effectively like shares in that NFT, really. And when they're traded like assets at that level, rather than sort of, just fewer transactions, higher art and stuff, it's quite an expensive tax, I guess, to pay on. That's sort of my current view. But I mean, like I said, it's not strongly held. I flip-flop on things most days. But yeah, at the moment, I think I would expect that you may see just royalties trend lower anyway. I think it's probably a good start, I guess. Because on very, on really high volume traded stuff, 3% on every single transaction is a lot.
Yeah, that makes sense. I actually really like the plan to enable creator flexibility in the future. That sounds pretty cool. And it's interesting to hear about the technical perspective there, that there's currently a lack of on-chain tools to efficiently support royalty payments. I think that's something that a lot of people probably aren't even aware of. And on your final point, you're right. If anyone here was paying a 2 to 5% fee on trading any other liquid asset, they probably wouldn't be too happy or doing it for too long. But it's going to be interesting to see how the royalty market develops for especially different types of collections as the whole NFT market matures. But moving on to the final question, what is next for NFTX? I know you're working on some cool integrations, but what else is on your long-term roadmap?
The current iteration is V2. I think the current plan really is effectively wrapping a bow on V2. These version of the contract's been running for over a year now, like 14 months or something. Seen a large amount of value, good amount of TVL. And it's most of it's about securing then these contracts, potentially making them sort of not upgradable anymore. So, they're just effectively set, as they are. So there's not so much, a risk of in the future, that's sort of a concern for, other parties if contracts aren't upgradable. So it's funny, I think tying a bow on V2 and adding the V2 functionality into, like we've got with the 0x API in for liquidity, it'll be probably tidying up and spinning up the new marketplace to sort of more match what we're heading with the Yield app, more personalization options or something. So sort of a nicer experience for like browsing using the marketplace. Really trying to make it much easier for users to buy, sell and stake. Like we're hoping soon to get out what we'll just call like a naked ETH zap. So at the moment, when you want to provide liquidity, you either have to have one of the NFTs or you have to have one of the tokens already, and then you pair that with ETH or whatever, and you add liquidity. Whereas I think a lot of people want to come on, they'll browse NFTX yields, they'll see the APRs, and they'll be like, cool, I want some of that. And then they go to stake and they're like, oh, I've got to buy this first, I've got to do that. So we're currently developing just an ETH only zap where you could be like, yo, I just want to put 5 ETH, into this pool. And then you can just be like, oh, I want 1 ETH inventory and I want 4 ETH in liquidity, and it'll sort of do all that magic for you behind the scenes. So basically hoping just to reduce a lot of friction in buying and sells in the short term. And then in the longer term, it would be like version 3 of the protocol, which again would have a focus on vault creators, as we mentioned, launchpad sort of stuff, really trying to solve, liquidity as best we can. So I think we'd quite like to move to Uniswap v3, where we can sort of tie in concentrated liquidity ranges, so we can have the infinite range backing it, but then also have the concentrated ranges and sort of allow people to then choose their range, where they're happy to be all in ETH or all in NFTs, and sort of set the fees that they want to set the fee percentage they want to earn. That's effectively the long-term V3 plan of NFTX right now.
Awesome. Looking forward to seeing everything play out. Thank you so much, Quag, for taking the time to do this. Really appreciate it.
Thank you for having me.